Mr. Mike McGlone, Mr. Ahmed Mahdi, and Matt Stanley. Thank you, gentlemen, for joining us. Ahmed, I'd like to go to you first, please, this morning. We'll start with OPEC. We're always starting with OPEC this week. They are in the news. We had their decision made yesterday. Probably not a surprise to most people. In your opinion, was it the right decision from a sort of fundamental supply point of view for the market?
Good morning, Dalia. So I think before the meeting, I think this was very much priced in. I think that there was some discussions about whether OPEC should increase a bit more than 400. Obviously, this whole gas to liquids issue was being discussed, as well as obviously the ongoing impact from Hurricane Ida, where there's still about 600,000 of refining capacity offline, and also updates coming from Shell on their Mars. But actually, the price of Mars is actually began to soften, indicating returning supply. And also we started seeing some of maybe a few weeks ago, we were talking about China being very robust into the next quarter. But actually, just from OPEC's perspective, there's a couple of factors, to take into account. I mean, I had a chance to read the internal OPEC report that was, part of the JTC last week. And actually, it's some very interesting figures when you look at 22 balances and what their view is of the surplus, in terms of the market, and also their view of demand, which actually stands at for 22 at 4.2 million barrels a day, which actually is really quite far off some consensus figures. So actually, there's a couple of
demand forecasts at the moment, at least for the next 6 months, it is exceeding supply, right? I mean, that is the case.
For the next few months, yes, absolutely. But in saying all of that, I think what was missing was, whilst everyone's talking about high gas prices, actually from an actual physical perspective, and actually, in terms of an operational perspective, it's not necessarily good for refinery utilization in some cases. It can impact margins, the cost of, say, desulfurization, or even in terms of the cost of running operations. And also, actually, there was some very interesting reports coming out this week that, perhaps in China, where you've got new power conservation mandates, that could also impact the refinery runs in China as well, and also the decision to allocate new fresh import quotas for the final quarter. So it's still actually a little bit mixed, and so the 400 was definitely justified. But I think the idea that OPEC should increase more, and also the last point I'll make is also spare capacity management as well.
Yeah, so I was going to ask you about that. Did that factor into their decision?
Obviously? I would say so. And actually, so really, they're not just the traders may be looking at or what have you, market analysts may be looking at a month or two, but actually, they also have to consider it for longer term, and the fact that they're meeting on a monthly basis means that they can do that. But as I mentioned, the kind of the bullish factors suggesting that they should hike a bit more need to be counteracted with some other issues that I just mentioned.
And I mean, just to follow up on that, Russia is obviously part of that decision making, a key member of OPEC Plus. Along with Saudi Arabia, they have been the sort of two main parties who've had to agree on policy, let's say, in the last 8 months. They seem to be on board as well. I mean, would their decision be coming more from sort of they're happy with the price, or that actually they are pumping at what they can at the moment when we're talking about capacity? A lot of analysts say, well, they can't do much more now anyway, so it suits them fine.
Yeah, I don't consider Russia to be a big issue. I'm not sure where this Russia-Saudi alliance, seems pretty strong within OPEC. As I said, I think that the key point is that the factors which suggest a really tight market are not necessarily the case. I mean, certainly, as I mentioned, ability to meet quotas, the concentration of members who actually have spare capacity is just a handful. Obviously, Iran has been delayed, but that we shouldn't discount a return. With regard to Russia, yes, there has been capex allocation decision making, towards they need to balance basically keeping their brownfields going as well as investing in new greenfields. But fundamentally, that quota of, whatever it is, 11.5 is unrealistic for Russia to meet, but on a sustainable basis. But that's, I think, in terms of calculated decision making, it's certainly, for me, there's no serious contention to suggest that Russia is unhappy with the current arrangement.
Yeah, it would strike me that it's probably very happy at the moment, as they all are, with the price where it is. Matt, if I could go to you, please, on that. We have a bulletin story this morning of the big traders being quoted, Vitol, Trafigura, etc. Agreeing, disagreeing on where they think prices will be in a year's time. That's quite a long-term view. But nobody seems to be straying very far off where we are today. How difficult is it for traders or OPEC policymakers to make decisions now because of the gas crisis that we're having, which is influencing the price? I mean, is that influencing traders at all, or they're just making their long-term bets?
It's a very good question. I think it's one, if you'd have asked Vito a month ago, I think their answer where prices were going would be a lot different to where it is now. I think there's some general undertones of concern in the market regarding, and it's really stemming from China, what's happening with China. Mm-hmm. This Evergrande issue, this news is buried. There was another bond payment due. I know they're on holiday at the moment, but the rhetoric in China has always been that they've been the savior for oil demand. And it's concerning when this huge deal, Evergrande, which is, like I said, is buried. It will have an effect, as Mike said on Sunday, Mike Muller said it to you on Sunday, it has an effect on the construction industry. That's a high using energy, part of that sector. It's unusual for Vitol and especially Russell to say 75 is where I see oil next year. Traffic went to 90. Are we going to be in a 75 to 90 range? Look, I mean, that's what you're looking at. But going to Russia, the question you asked, Ahmed, it's a very difficult one. Russia obviously factor keyly in they're a key factor going forward. But the convenient excuse of COVID is now being used as some kind of leverage by the group. And I don't understand that when majority of the year so far it's been largely ignored and dismissed. You can't then protect your position regarding output, regarding the pandemic, when they have hardly acknowledged it all year. The demand is returning. Is it enough to justify prices in the mid-80s, which they will probably get to by the end of the week, because there isn't enough oil in the short term? I don't think there is. I think a rally that is wholly sustained on supply being choked off when the world is coming back from a pandemic is a false economy completely. And I think Vitol are hinting at that. I think there is, if you're in New Zealand and not Auckland, you're still locked down. You can go out hunting, that's all right. But, everywhere else is kind of opening up. A lot of places are still locked down. So this general undercurrent regarding people being concerned around COVID and perhaps Evergrande manifest, no one really knows the story, but free money and fiscal stimulus, has it manifested itself into a bubble in China, a property bubble that's about to pop? And if that does happen, or if it gets bailed out, or whatever might happen, whatever's restructuring may occur, it will have some kind of effect on sentiment going forward. And those traders, apart from Trafi, I mean, I worked there for years and they've never been anything but bullish. And you can't be if you're a trader. You can never be a bear, which is why I'm not a trader anymore at Diala. But it's a general concern that the market has got. It's one that Mike has certainly had, and I've shared his view all year, in that both of us, if anyone wants to ask the question, the real surprise of the year is, where is US oil? Where is US oil? Are they continuing to beef up balance sheets because they never want to get to the cash strap position they were in last year? Look, it's so far this year, they haven't come back, but I think it's coming.
Yeah, and let's go to Mike on that. Hi, good morning, Mike. Mike McClone, Senior Commodity Strategist at Bloomberg Intelligence. A very early morning to you there in Miami. Mike, on that point, I mean, just to go back to prices and stimulus, Matt was just mentioning that, obviously. I mean, the monetary policy stimulus that we've seen across the board, many would say that is what is pushing everything up, not just oil, but all commodities, food, etc. You've been a bear most of the year, and I assume you're staying that way. But let me ask you on the inflation question, where we're seeing some serious concerns now, maybe more in Europe than the US. will inflationary concerns keep prices in check, do you think? Or what other factors will, in your opinion?
Let's look at inflation. So we're going to measure inflation next year as of from now. So it's definitely going to come lower. But I think one thing to look at is look at the price next year, look at the futures curve. I see DEES 22 a year from now, Brent at $73.70. And I think that's pretty accurate because what Matt mentioned is just the classic example of free market capitalism and profits in U.S. shale. The average cost of production for U.S. shale now is $35 a barrel. And rig counts are starting to take off. And unless you expect that pure profit not to matter, then yeah, supply won't come back, but it always has. And so to me, I think OPEC's just it's going back to the same old story it has that kicked in 2014 when markets collapsed, prices were high around 100. We're just now at the lower level. So if you look at the midpoint of the bear market from the peak in 2008 to last year's low, it's around $81 a barrel. We just got near there. It's actually right at $81.40. We just got near there, and we have extremely low inventories. The rules of commodities is, higher prices are the cure, and low inventories are usually put in peaks. So I think that's going to kick in, and then what's going to happen a year from now? How much more stimulus are we going to have? We should be in a more organic economy, and I'm looking at it as we're kicking into a new cycle unless we expect the old cycles that have really been in place since the peak in 2018 to end, which I don't think so. So fully expect U.S. supply to come back on. How about oil sands out of Canada? They're all profitable now at these levels. And that's, to me, is a key factor.
Well, when do you expect U.S. shale to come back in significant extra sort of volume, if you like? I mean, we're seeing rig counts ticking up gradually in the last few months, you could argue. Many people are saying for the next 2 quarters, we still won't see any U.S. shale of significance to impact supply on the market. Would you agree with that? I mean, is that part of OPEC's thinking that they're assuming that until next April, nothing's going to move on that front?
I think it's part of the thinking, but I think it's very remiss to expect profits not to matter. And also, what's really been driving this rally, as Matt mentioned, is a lot of it's been natural gas driven. We've had hurricanes. That's not usually a good way to have a demand pull sustained bull market in crude oil. This has more been a supply issue, and certainly in this country is an oversupply of natural gas. U.S. shale natural gas should be coming back on. There's plenty of wells in Pennsylvania that's been waiting for profits, and we're there. So to me, it's the key thing that's been keeping the whole price of crude oil down for years is just starting to kick back in. Now, we mentioned China. What's really happening in China and Evergrande is the bigger picture of China's demand estimate and revision starting to really decline. This is a factor before COVID. Look at copper. Copper's not been able to break above that $10,000 a ton level. It looks like it's peaking. That's key direction related to China. And then, just crude oil. I look at it as, I'd love to see crude oil go higher. And as Matt mentioned too, as as an ex-trader, you're supposed to be bullish. Well, that's the cool thing I love about Bloomberg. I'm not a trader anymore. I'm just supposed to get it right. And I look at these levels, the market's very much more likely in crude oil to act like it did in the grains, where high prices brought on supply, and now we're back down, and we got off those peaks. This right now is the storm, and we have to expect this prices might bring on the new cycle that we had that really was a problem until the bottom last year.
Ahmed, just to go back on to supply, we've just talked about the US, Iran, again, another sort of obviously big supply factor that people are factoring in. The consensus now seems to be, again, that's not something we can even consider for the next 6 months, regardless of how negotiations go. Would you agree?
So going back to comments earlier, one of the factors that was, sustaining that momentum on the future side was obviously the disappointing outcomes and deferred schedule surrounding Iran. Which was, expected earlier this year. But I think there's a couple of interesting dynamics at play with regards to that. Firstly, at this kind of flat price strength, Washington reached out to Beijing, I think, a few weeks ago. We've been seeing acceleration of some small-time sanctions on entities around Oman and Hong Kong around, trading either on the crude products or even petrochem side related to Iran. And the idea was reaching out to China to sort of say, to cooperate on Iranian cargoes, purchasing Iranian
But
cargoes.
are those volumes significant for the market?
No,
I mean, long term, yeah.
So with regards to actual flows from Iran to China, that's been averaging for this year around about 550,000 barrels a day. And I think actually at this kind of price level, you might start seeing more leakage, in terms of, particularly given where refinery margins are in China, some of that pressure on, and also actually, particularly with the private refineries there as well. China did do an SPR, but not very much, not very much was released. But you could expect, that to see further, Iranian volumes heading to China. Secondly, I think that the interesting question, the interesting strategy with regard to Iran is effectively this kind of policy of brinkmanship and doubling down and buying time for, to extract a sort of, some kind of concession to effectively come back to the table. Because right now, it's better to be negotiating in this kind of environment than say where we expect to see next year, where, going back to US production, most of the credible estimates suggesting about 800,000 barrels a day of growth from the US next year. So in this current environment, the Iranian, I think we should probably see a deal early next year. But right now there's a lot of a lot of these kinds of attempts to try and extract the best possible deal.
Matt, just on the concept of volatility, I mean, we obviously had quite a not too volatile a market in recent weeks, but I mean that is being cited as what to watch out for in the next quarter. It's going to be a pretty volatile oil market, also because of gas and what's happening there. We have an article today citing the Aramco CEO, who's saying he's expecting strong demand and the industry has to invest and it hasn't been investing enough. And obviously Aramco is and Saudi Arabia is, but volatility is good for traders and not so good for sort of long-term investment. When would you expect that this resurgence perhaps into the investment that's needed will start? I mean, we've had pretty good prices for a few months now. Are we going to see that coming in seriously at any time soon?
Well, it's a good question. And, Mike touched on it earlier. If you look at the forward curve, it's $73 a barrel, I would say, is fair value for Brent crude right now. People are taking out some options, some DEC 23 call options for traders today at $95 a barrel. It's still there, Diala. Liquidity is still there further down the curve. The issue, though, is the people who are investing in the market, the hedge funds, and they will pile into the front month, and they will pile in with a lot of weight, and they can come out of their positions at the same time. So if we look at it from a fundamental point of view, and this is why the hesitancy is on that further down the curve, say second half next year. Majority of people I'm speaking to, bullish traders, and they will remain nameless because otherwise they wouldn't be traders of mine anymore. They are concerned that by May next year, the market will be in a surplus again. And that's just on OPEC balances. That's not with, as Mike was saying, the imminent return, and it's been imminent for the last 4 or 5, 6 months of US crude oil. The minute that does start coming back, because the rig count is back to where it was sort of March last year, right? But production is still, say, about 1.6, 1.7 million barrels a day lower. It is inevitable that some of that oil will come back. So there is hesitancy and concern that Q2 next year, the world will be in a surplus of oil again. Would you invest in a market that is hesitant in that regard? Listening to ADNOC Drilling, released an IPO on Sunday, and it was oversubscribed. Of course, they're all oversubscribed because you don't release enough shares, and of course you have oversubscription, right? That's shocking, that. But the question comes in: if you're a hedge fund and you've got a green agenda, do you invest in a drilling company for fossil fuels? That's the long-term argument. That's what a lot of people are looking at. But if we're looking at the short term, and that is up to 6 months' time, Q1 next year, really, we could start seeing some serious builds in inventories across the globe. And by the end of Q2, once all the OPEC barrels are back, We could be back where we were 3 or 4 years ago. And that's the issue that the majority of the market has at the minute. That's the hesitancy.
Mike, I mean, given that sort of forward outlook, let's say to Q2 next year, assuming we're going to have, obviously more supply coming on, whether it's from the US, more OPEC barrels, etc. And the other equation of obviously the pull on that supply, which is demand. And let's go to the US economy now and talk about any concerns there from a sort of consumer point of view, from an inflationary point of view. Again, talk of stagflation in Europe, and let's talk about the US, its debt ceiling, and the issues they're having there. There's certain states that are still even not out of the COVID quagmire yet. Where do you see the US economy in the second quarter of next year in terms of demand, in terms of consumer confidence, and how much of a concern will inflation be by that stage?
Peak. That's the key word. It doesn't get much better than almost 6 to 7% in the bounce back from COVID, massive amount of fiscal stimulus reopening. And that's the key thing. Come next year, we're looking at a hangover. We're looking at normalization. We're going to have an election. This is going to be, won't be a Democratic sweep. And that's the key thing we have to look at in commodities, the cycles. And, I hate to say it, but as a commodity guy, you look at this is like, oh, this is just, you're supposed to bring out the responsive sell tickets. And if you're bullish, good enough to be bullish for it, that's wonderful. But it's a key lesson you learn in grains. They cycles go much faster. And so come this time next year, we're probably going to have had a stock market correction, maybe 10, 20%. Someday we'll get that. That hasn't made a difference yet. It just doesn't get much better than 6%. So we should go back to, I think, what we were before COVID. It might even be worse. We're struggling to get 2% GDP growth. And we're struggling to get the WTI above $60 a barrel. And we go back to normalization. Then you look at the consumption issue. Remember, there's elasticity of demand too. Elasticity of supply, we all know is going to kick in. Iran, at some point, US shale is going to come back, but elasticity of demand, the higher prices means we should have a little bit of a response in demand. The key thing to remember about the US, the most advanced economy here, is total liquid fuel consumption in this country is the same as it was 20 years, around 10 million, actually 9 million barrels a day. Total liquid, that's for motor fuels. For liquid fuels, it's around 20 million barrels a day. It's flat. It hasn't gone up at all. And it's going to probably start ticking down with just EVs kicking in and efficiency.
Well,
so
let me
it's just a
talk
matter of
about
time.
efficiency for a minute. And we just have the survey question up asking, if you would bet that would you bet $100 that we'll have $100 oil in the fourth quarter? We'd love to get everyone's answer to that. We'll look at the results a bit later in the next few minutes. We did have Bank of America saying we're going to hit $100 oil soon. But on that EV point, Mike, and energy transition as a whole, we've had a lot of commentary in the last couple of weeks as prices have gone up and panic has set in across the board on supply and supply chain problems and commodities, and energy needs being met. That the argument from the naysayers that this energy transition is just moving way too fast, and that we need to be paying attention to energy needs today much more, considering the crunch we're having today. Would you agree with that?
As finally, we've got a little more respect for fossil fuels. I think people are learning that, which fossil fuels have made our lives wonderful. And yeah, the transition's been too quick away from coal to natural gas. This is going to push it back a little. To me, it's also the price adjustment factor. Once we have prices up at these levels, I see massive potential profits. And you're seeing it in the equities. Yes, it's not completely ESG, but you can carbon offset it. Supply will come on. It's just free market capitalism. And I look at cost of production. People in the shale patch are just salivating at the money they're making here, and they're selling forward in the curve, which Matt mentioned and we've talked about earlier with the steep backwardation. They're selling forward. They're already locking in profits, and they can show that to their financer, their banks and things.
Matt, just to go back to China, putting aside the Evergrande financial market, let's say, issue, but of course it
as the market is, yeah.
It's a construction, obviously, company, and that is an energy user. But we've had headlines again coming out of China saying it might run out of coal in 2 weeks to meet immediate supply. I mean, that's pretty critical for one of the world's largest energy consumers. How much is this new reality of GDP at a lower level and the current power crisis in China where government doesn't seem to be panicking too much about what's happening, from what it's saying at least. How much is that playing into traders' thinking today in terms of what the trajectory might be?
Well, the thing is that all traders have been so complacent about strong Chinese growth over the last 2 decades that a change of thinking is really something they don't want to get together and sit around a table and discuss. Well, if China aren't there to buy it, what are we going to do with this material? Now, the savior was last week when someone said, don't worry, we need it all, lift it all, I'll take it all. So of course, thermal coal has gone from $35 a ton to what, $130 a ton now. The Baltic Index, which majority of the time for the dry routes, the Cape sizes, all ends up in Ningbo. That's at a 13-year high, $80,000 a day for a Cape size vessel. No, I used to work for a freight broker. I remember maybe 6 years ago, it was down to about $6,000 or $7,000 a day. It's all down to Chinese strength and perceived demand, confidence in the country. And look, it's been incredible. The story and the path that China have been on is extraordinary. There are cities there that people haven't even heard of, with 30, 40 million people in them. So is it a concern that the market are going to have? Look, I read an article this morning that said, if renewable energy kicks up in China, then perhaps that'll offset the amount of coal that they will buy. The agenda will stay the same. It's the cheapest form of feedstock they can get, whether it's power generation, whether it's coking coal for steel mills, whatever it might be. It's going to be the cheapest form of imports that they can possibly get. So there will still continue to be big buys.
And Europe, we've seen Europe now resorting back to coal when it's obviously got much stricter policies and directives to exit from that. It just shows that countries will have to turn to that, albeit a temporary a blip. But I suppose the argument of the whole market softening in the next 2 quarters is backed up by the fact that China is on a new trajectory. Ahmed, we've almost run out of time. I'm going to ask Irene just to put up the result for the poll that we put up earlier. Oh dear, almost neck and neck, 50-50. Okay, there's enough people with $100 in their pocket. That's good to know. But certainly a week ago you'd have said yes, and now I would have said no. So the volatility certainly is in there. Ahmed, before we close today, just to give you the last word, and also ask you about the Iraq elections, which are coming up this Sunday, I believe. First elections in 2 years. In as usual, a very volatile political environment. What should we expect from that in terms of what impact any result might have on the country's economy and specifically on oil, obviously?
So there was speculation that there was, a few months ago around delays. I think the takeaways, because we only have 2 minutes, is really expected low voter turnout, despite the shift away in terms of the electoral lists and the electoral law kicking in. There's still a high chance of voter fraud. I think in terms of oil policy, I think the interesting debate, going on is that whilst the oil minister's done, lots of great things, and the big headline grabbing news around Total Energies, and all of the big deals surrounding BP's position there at Rumaila, etc. I think the reality is that there's still a lot of, capacity constraints on the export side, actually, despite the upstream, dollars still flowing. Also, there's an attempt to create this new, INOC, this Iraq National Oil Company, to transfer the duties of the ministry to a new entity. And I think that's a lot of that's to do with the sort of, part of the elections as well, to sort of, transfer power away from the ministry to a new entity. But that's still subject to legal disputes. In terms of the actual political balance of power in Iraq, that's still very much expected to, rest in the hands of, the Sadrists and also some of these Iranian-backed groups as well. I think the interesting question will be what happens to the future of Mustafa Kadhimi as well, and also some of the more liberal members of his entourage, whether they'll continue, because they had last year at the peak of the COVID crisis a government white paper to install economic reforms. And so what happens to the future of that will be very interesting. And then finally on Kurdistan, they're still trying to thrash out negotiations, but I think that now there's been, a bit more of an alignment of interest between the Kurdish Democratic Party and also the Sadrists as well. And that has implications for exports through Ceyhan as well.
You mentioned the export fund where they're still having restrictions, and so those are more political rather than structural.
Sorry, repeat the question, Dalia. I didn't hear that.
The reason why exports are being challenged is politics.
No, the exports have always been. I mean, the idea. I mean, the reality is that exports from the south, the maximum capacity. And I was speaking to people within SOMA about this, trying to work out the realities of this. Is that the reality is that it's all to do with midstream storage constraints, and basically now they have actually more complex configurations of crude coming out. Actually, the storage is creating some quality issues, and the realities is that the maximum from the south is around about 3.6 to 3.7 million barrels. The real problem, I think, which is not talked about because there's not much visibility, is to do with the subsea pipelines that goes from the onshore to export terminals, and there's some big problems with corrosion of these pipelines, and so they're trying to replace those, and the time frame for that is really dependent on what happens with these EPC contractors. And it's a long story, but the long and short of it is that the idea that Iraq can sustainably export beyond 3.6 is not true. So again, that this feeds back into the point about who really has the spare capacity in OPEC, and those figures need to probably be revised as well.
Yeah, because Iraq has obviously been on paper one of those who can, but
exactly.
There are restraints. Ahmad Mehdi, thank you very much, from the Oxford Institute of Energy Studies, Matt Stanley, Director of Star Fuels, and Mike McClone, Senior Commodity Strategist at Bloomberg Intelligence. Thank you very much, gentlemen, for joining us this morning.
Thanks,
Thank you.